last week, we wrapped up IUL month talking about all of the expenses inside of the IUL. Be sure to check that out if you want to know the finest details about what you can expect for expenses inside of an IUL. Well, we needed to extend IUL month one more week because today we're talking volatility-controlled indexes. These are some of the most popular indexes out there that you will find in the IUL space, and a lot of them offer a high participation rate and uncapped growth, which is kind of why I think they are so popular. But we're going to dive into what they are, how they work, what have they done in the low interest rate environment and the high interest rate environment, and hopefully anything else you need to know about these things so that you can manage them properly inside of your IUL. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Vaquera with Net Wealth Finance.
All right, we're talking volatility control indexes. There is some fatal flaws, I think, in some of these, and really just terrible underperformance that I've noticed across a whole bunch of IUL products. Is there a fatal flaw in the idea of volatility control indexes? We're going to kind of dive into everything that you need to know, and you're definitely going to want to hear this out so that you understand how to use these things when it comes to allocation time on your anniversaries. But first, let's start off with, what are these things? What is a volatility-controlled index, Carlo?
So these indexes will shift based on the volatility that is happening in the market, and they want to reduce the amount of that movement in the index.
Yeah, and we're going to see a bunch of different strategies employed across the different volatility indexes, where some of them may have a 5% target, some of them might have a 10% target. The target isn't necessarily the defining characteristic. You don't want to let that fool you, because you might see 10% target and think that that's what they're going to get all the time. Not necessarily. They're going to utilize the volatility controls to avoid big drops in the marketplace, and where they end up hiding and for how long is going to be dictated by whatever that mechanism is. There are also some that have mechanisms that do better in certain interest rate environments, and they might be able to control the cost of these things by doing something like an excess return instead of a total return. A lot of different key factors in how these things get designed that it's probably a little too deep for most IUL buyers to get into. They're probably not that concerned. Really what it boils down to is like, okay, but where am I going to make the most money? Every single IUL utilizes at least one index. What's that index?
All the IUL carriers are going to have an option to have an S&P based index with a cap.
Now, why do they need a cap on the S&P index?
Well, the reason is because the S&P is a volatile index. It has great returns, and when looked at over a very long period of time, it can have a nice, steady-looking return, but in reality, you can have giant swings in the S&P in any single year.
Yeah, and it's that volatility that makes buying options on it very expensive, because how much an index might move over a given time period is going to determine that underlying cost. The more it moves, the more volatile that stock is or that index is. And so the volatility comes at a price. Somebody's going to pay for that. There's a ton of money to be made using options when it comes to volatility. So one of the things insurance companies figured out a decade or so ago is that if we can somehow avoid some of that volatility, we might be able to get options at a more consistent price. And that could be good for the buyers of our products. What was their solution to doing that?
So they'll work with financial institutions to come up with these proprietary indexes that aren't open to your normal options traders. They're not open market. And what that gives them access to is a closed market that the options price is much more controlled, and as such, cheaper for them to be able to have access to that upside, but that downside protection since they're not spending too much on those options.
Yeah, they're going to work with these financial institutions to create special products that institution is going to guarantee the payout on these options. That's essentially what's happening. It's a behind the scenes agreement that says, okay, we're going to put together this basket into an index and we're going to track the growth of that index. And we're going to give you the upside potential on this thing. Now, there's all kinds of different strategies that they can come up with. And one of those we see very often inside these volatility control indexes, and that's the excess return index, or you might see it as an ER. Well, we have what's called total return, and then we have the excess return. If you're looking at a volatility controlled index and it just has its name, something like Barclays Global MA Index, that's going to be a total return index, as opposed to HIMCO, Tactical Balanced ER, or S&P Mark 5% ER, or Bloomberg US Dynamic Balance 2 ER. There's all kinds of different names on these things, but when you see the ER, that means excess return. Excess return means above and beyond the risk-free rate. What would be the advantage of not having to deal with the risk-free rate when it comes to options pricing?
Well, that's what's going to reduce that options cost even more, because when they're subtracting out that risk-free rate, that sort of treasury rate, that is, they know that they're not going to have to pay out that risk-free rate. And as such, you get access to those cheaper options. And what that really means to you as the client is access to not just uncapped returns, but higher participation rates, anywhere from 140% to as much as 320%. So you could get as much as 3 times, a little bit more than 3 times the return of the underlying index, which is pretty fantastic.
Yeah, the way that they've come up with working with other institutions to give uncapped options has been really neat. And one of the things that we saw was in the low interest rate environment, all of these volatility indexes that have come out recently, they were all back tested in a low interest rate environment. And then a lot of them were enacted and still had a number of years in a low interest rate environment where they performed pretty darn good. What was the problem though?
Well, when interest rates started going up, the excess return subtracts out that guaranteed or that treasury rate basically, then they're not doing so great. And that's a problem for a lot of these. It's not all of them. So there's some outliers. We'll probably discuss a bit more, but many of these volatility controlled indexes with the ER component have struggled over the past few years.
And really what I've noticed, it's not just the ER indexes. Almost every volatility controlled index has underperformed once we got into the high interest rate environment. And surprisingly, a couple of our best performers are the ER indexes. So I wouldn't just utilize the ER as saying it's not going to do as good in a high interest rate environment. And the whole asset class as a whole, when we look at all the different volatility control indexes, there's a stark difference between pre-2022, which was your low interest rate environment, and post-2022, which was the high interest rate environment. And if you look at the charts, most of them dropped and went sideways once we went into 2022. Well, what happened in 2022?
So both the bond market and the S&P, they lost like 30%, and it was a little bit of a bloodbath.
Yeah, and there's basically nowhere to hide. So even if you're a volatility control index that is going to shift asset classes, you couldn't go from equities to bonds and avoid the downside. Really, the only safe place was cash. And there were some volatility control indexes that have that ability to go to bonds or cash. And those ones tended to do a bit better. Now, the bounce back was wildly varying because only some of them experienced a good bounce back. Some of them had better downside protection, but never did recover and continued to go down. And then other ones just lost a whole lot of money and never recovered. And then some of them might have lost a little bit or even lost a lot, but then did have the ability to recover. It kind of runs the gamut.
Yeah, and one of the reasons for that is because of the underlying strategy that tends to be when there's high volatility, hide in those bonds and minimize that equity exposure. But that high volatility, that big bounce back that happened, was you needed to be in equities in order to really experience that bounce back that was pretty drastic. Some of the strategies were not great for that environment.
We know that a lot of them have struggled, not all of them, but let's reverse back just a little bit and let's talk about what actually happens in a high volatility environment. 2022, not only did we experience higher interest rates, but we also got into a pretty highly volatile environment with stocks and bonds dropping so drastically. What happens in a high volatility environment within these volatility controlled indexes?
So that's, as I mentioned, that is where they'll reduce how much exposure they have to those equities and generally move more towards that bond component or that cash component in order to protect their principal and that goal of reducing that volatility. So that's how they'll operate, and they'll try to reduce the volatility by moving out of equities.
So at the risk of getting too in the weeds here with numbers, we're going to use an example. If you have an index with a 5% volatility target that measures recent volatility of equities at 10%, it might shift its allocation to be 50% equities and 50% cash to bring the overall volatility back down towards 5% target. This is how they avoid that market turmoil. So if 5% volatility is the target, remember, this isn't a 5% return goal. 5% volatility. They're going to adjust their equities, their position in equities, bonds, and cash in order to match that 5% volatility when one of the other ones spike up, whether it's equities or bonds.
In the opposite situation, so in a low volatility environment where you might want to ratchet up that equity position and move away from those cash and bond components, that's what they're going to do in that lower volatility environment. And that's kind of where, the situation in 2022 was particularly bad, because when all of these things are going bad, other than if their strategy defines that some of it not all of it goes to cash, then they didn't go all into cash or whatever the situation is. And they were double whammied with the situation in 2022 for many of these volatility controlled indexes.
And I hate to say it, but 2025 was also a very hard year for volatility control indexes. Earlier this year, we had equities take a really steep dive. It happened very quickly. The S&P, I think, lost 17% over the matter of a little over a month. Some of our good volatility control indexes may have only gone down 5%. They did what they're supposed to do. They shifted away from the volatility. But volatility remains high for a while. It doesn't come down immediately. And the market, or let's say the S&P, which we're considering the market right now, bounced back really quickly. In fact, it was the third fastest recovery on record for the S&P. And what happened is it recovered faster than volatility dropped. So these volatility controlled indexes that had to flee equities didn't get back into equities for the recovery. So they didn't get the ride back up very quickly. And if you look back across all of your volatility indexes, most of them are still lagging behind today and haven't gotten back to their all-time highs, if they were at their all-time highs before, or not even at the highs that they were at prior to that initial drop. But there are some that have. So it's really key to work with agents that pay attention to these things and understand what's happening inside of these products that you're looking to get. Because not all volatility control indexes are the same. There are some that I would never use right now, that if you just look back at the history of actual performance since 2022, it's been terrible. The performance before 2022 might have been good because we were in the low interest rate environment. And maybe we would reconsider using those volatility control indexes again if we end up in a low interest rate environment again. But in this high interest rate environment, some of these have shown no ability to make us any money. And I see no reason to have any exposure to those volatility indexes. But I see some agents putting their clients in those at 100% allocation, which is almost criminal, but they don't know what they're doing because they don't understand what's happening inside of these products.
Yes, and I think that's one of the things about it. When we look at these volatility controlled indexes, and maybe when a lot of these agents may have gotten into the business, this concept of back testing was used to create these, and you got this great history that's been said on these back-tested strategies. When the environment changed, that back-testing, a lot of it was in that recovery period of that Great Recession, where we had historically long, low interest rate environments that kept going down and down and down. And these volatility-controlled indexes were good for that type of environment, the strategies that they're implementing. Things have changed. Maybe we'll get back to that. And I think it is important that agents understand these concepts in order to help their clients and ensure that they're smartly allocating based on the products that people are in.
We're going to put a document on our Substack that does a deep dive into these volatility indexes and goes way more in depth than what we can cover on a podcast like this. Be sure to check out our Substack, subscribe while you're there, and check out that document. I think we're going to wrap this up here about volatility indexes with the idea that not all volatility indexes are created equal, and it's really important for you to do your due diligence when you're exploring which products to get and what options you have access to, which index choices you're going to be able to choose from. Are there volatility indexes? Are they good ones? Or should you just stick to the bread and butter S&P indexes? There's a lot of choices out there, but make sure that your agent understands these as well. I think it's really critical, if you're looking to buy an IUL, that you're working with an agent that pays attention to these things, understands the dynamics of the market. Life insurance agents are not licensed to sell you stuff that's in the market. And because of that, they mostly don't even pay attention or may not even know about any of these things or about how they work. That doesn't mean they can't be a good life insurance agent. They may not be a good agent to have an IUL with. Something to keep in mind.
Yes, and I think that's a great point. When considering the number of people who become life insurance agents, who get into this business, most of them are not necessarily on this cash value focus. And that's where we focus on that cash value component, both on the whole life and the IUL side. And having that knowledge and understanding of the market is a big component of that.
So what's a good call to action for our listeners this week?
It's time for this week's call to action.
Well, you already said it. You called it out. Check out our Substack. We're trying to put out some more written content alongside of these videos, and it is going to be super helpful. Great information on the Substack.
And of course, they can always get in touch with either of us or Jing, although she's not with us this week. We're all certainly available to have in-depth discussions about these products, what they offer, what indexes might be a good choice, how they might fit into your overall portfolio. Because I know when I meet with clients, we're looking at the big financial picture and what index options they're choosing within an IUL should kind of fit in with the rest of their goals and their investments.
So that's the main thing, the holistic approach to building a solid financial foundation. That's how we like to look at things. Sometimes that means it might not be the right move right now, and we'll tell you that if we think that.
All right, that's it for IUL month, and volatility control indexes wraps that up. Next week, we start on whole life. We've got 4 weeks coming at you where we're going to dive into everything you need to know about whole life insurance. So be sure to come back. With that, my name is James Barber. I'm your Oregon Cash Flow Pro. I'm licensed for life insurance and annuities across the country.
And my name is Carlo Vaquera. You can find me at netwealthfinance.com or on YouTube at netwealthfinance, and we'll work with life insurance clients across the country as well.
Take care. We'll see you next time.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.